Good afternoon, everyone. Welcome to this webinar where we'll be talking about smart beta funds. And I think this is going to be very important webinar because we are especially going to focus on what worked for smart beta and what didn't work for smart beta in last 6 months during when we saw very significant corrections in the market. There was underperformance by momentum and alpha funds. We'll talk about whether that was as per expectations or not. There was also sorts of underperformance by low volatility funds also. So we'll talk about what happened there. So in this particular presentation, I'll talk about markets, I'll talk about concepts of smart beta, and also focus on what happened in terms of performance and portfolio in smart beta funds in last 6 months. So without any further delay, let me quickly start the presentation where, as always, we'll first talk about what is happening in the market. And I think we are finally taking a sort of relief by looking at the market in last few weeks, as Indian markets are sorts of performing differently to how the US markets as well as Chinese markets, for examples, are performing post the tariff imposed by Trump, and then obviously a lot of flip flops which have happened in US policies on tariffs, and there are still significant amount of confusion in the market of what may or may not happen, right? All this. What how the negotiations with countries including China, India, Vietnam, Japan, South Korea, and other larger blocs like EU will happen. Who will be relatively better placed? Who will sorts of come out on top in negotiations? Are we going to see a significant impact on global growth, right? When tariff got imposed, the estimates were that global growth will be impacted negatively by the tune of almost 1.5%. Are we going to see recession in US, the probability of which is increasing day by day? Are we going to see sorts of sticky inflation in US? I think probably the answer to that we can say is now yes. And how different asset classes are going to behave, how US market is going to behave, how Chinese market is going to behave, which is the most impacted market outside US because of the tariff issues, how India will behave relate because it seems like that we are relatively better placed compared to other Asian economies when it comes to tariff, which has been talked about Donald Trump's administration. Also, interestingly, how different asset class will behave. Crude, US Treasuries, right? The yield movement which we have seen is unlike what we have seen in recent times, and also how dollar index is going to behave, right? We are seeing sorts of breaking of correlation between yields and dollar index, which is surprising, right? And because of which also we are seeing sorts of support in gold prices also. Gold continue to do well because dollar is depreciating. We are possibly looking at US recession, higher inflation. Central bank continues to buy gold as a safe haven asset. So there are a lot of moving parts in global markets right now, and then it is great to see that we are relatively better placed, and also markets have reacted quite differently when we are comparing to how global markets are performing. So in month till date, and this is yesterday's ending data, Nifty has moved up by almost 2.8%. Next 50 is up by 4.2%. Small cap is up by 5.1%, and mid cap is up also by 5%. So large cap around 3% up, whereas mid and small cap around 5% up on month till date. The only Segments which are negative on month till date is IT, which is down by 7.8%, as well as metals, which is down by 4%. Apart from that, I think we all have been following markets keenly, and the sector which is obviously providing the most momentum is financial services. So if you're looking at NSE financial services, that is up by 6.2%. Whereas if you look at banks within financial services, it is up by 8%. I think contributed equally by private banks and PSU banks, which is up by 8.1 and 8.9%. Manufacturing is sort of flattish. We are looking at 2% flat movement by manufacturing, as well as autos, right? Which uh, uh, manufacturing segment as a whole will have higher impact if tariff does play out, the quantum of which remains unknown, and will be sorts of uh, uh, clarity will come out post negotiations. And if you look at consumption, that's also something which is interesting, right? Because consumption was the first segment which got hit when market correction started. But in last month till date, we are seeing India consumption, which is a broader index, up by 6.3%, FMCG up by 6.3%, consumer durables up by 7.6%. Even energy and infrastructure is up by 3% or so. So we're seeing sorts of a broader rally where we are seeing energy, oil and gas, consumption, banking, even manufacturing, etc., giving positive returns. The negative segments being IT and metals as of now. When we compare this with what is happening in US as well as China, we see that in month till date, Nasdaq is down by 7.6%. Surprisingly, S&P is down even more. S&P 500 is down by 8.1%, whereas Hang Seng index is down 9.4%, and Hang Seng index uh, Hang Seng Tech is down by 9.4%, and Hang Seng Index, which is HSI, is down by 6.9%. So we are seeing negative movement in both US and Chinese market. And even if you look at YTD numbers also in US and Chinese market, you'll see that US markets have now corrected significantly, significant double digit fall, whereas Chinese market, after obviously recovering significantly by post years of underperformance, are now again reeling in last 1 month due to the obviously tariff war. Now, when we compare it with how now indices are looking from their 52-week high, and you can look at this particular column. Now we can see that Nifty is now just down 8% from its 52-week high. Next 50 is down 15-16%. Mid cap is down 11%, small cap is down around 14%. So if you're looking at a range for broad market indices, it's roughly in the range of 8 to 15%. Next 50 is down the highest, almost 15 to 16%. And we have talked multiple times in a previous webinar about why Nifty Next 50 underperformed. If you're looking at other segments, I think as we discussed last time, private banks, financial services, bank, etc., are down the least from its 52-week high. In fact, bank is now trading around, financial services now trading around its 52-week high. Again, most of you will already be aware. But apart, if you look at other sectors, manufacturing is down 15% from its 52-week high, auto 21%, and the other segments like consumption, etc., which were down much more, are now hovering around in the range of 10 to 13-14% in the negative territory. If we look at sectors, segments which have fallen the most, it is IT, which is down almost 26% from its 52-week high, energy, which is down almost 23% from its 52-week high, and power, which is again a sub-segment of energy, is down almost 22%, and reality which is down almost 24%. Interestingly, now US market, if you are looking at comparison from 52-week high, FANG is down 23%, Nasdaq is down almost 20%, S&P is down again 19%, Hang Seng Tech and HSI also is down almost 21 and 13.5% respectively. So that is how markets are looking in last 1 3 months or so, and this is the yesterday's ending data. We are seeing sorts of rally in Indian markets. Whether this will continue or not depends a lot on earnings which are coming out, as well as macroeconomic indicators which will come out. How are we now looking at urban and rural consumption, etc., will impact which way the market will sorts of turn now. Whether this relief rally will continue, or whether are we going to see sorts of corrections in Indian markets also after this relief rally. Now moving to our main topic, which is smart beta. So what I'll do is I'll talk about smart beta as a concept also, because some of you might not be aware about what is smart beta. But majorly I'll talk about in terms of performance and what has happened in last 3 6 months. So smart beta is a concept where instead of creating indices based on market cap, Nifty 50, which is top 50 stocks, mid cap 150, which is top 150 mid cap stocks. So stock selections are done based on market cap. Even the weighing is based on market cap. The largest stock in Nifty 50 is HDFC, because the HDFC free float market cap is the highest. In case of smart beta, the selection is based on factors, right? For these factors can be momentum, quality, value, low volatility, alpha, etc. Even the weight of the stock is sorts of dependent on how well they are doing on these factors. So for example, in case of alpha index, which we'll talk about, not only stocks are selected based on their alpha score, which means that how well they have performed in last 1 year, but also their weights are based purely on alpha score. So for example, if there are two banks which are selected because of positive alpha, let's say for example it is HDFC Bank and let me take a smaller bank, which is let's say Federal Bank. But Federal Bank has given higher returns, its alpha score is better, so Federal Bank will have higher weightage than HDFC Bank, right? Which is unlike what happens in broader indices or market cap based indices. So smart beta uses these factors to select stock as well as weigh stocks in the portfolio. The idea is to target these characteristics. So if you want to target higher returns, you are okay with higher risk, then momentum and alpha funds are for you. If you're looking for more stable portfolio where you are okay with marginal outperformance with lesser risk, that low volatility is for you. If you're looking for investment in value-based portfolio where you are selecting stocks which are low in PE, PB, etc., then value-based smart beta funds are for you. If you're looking at low size, now low size is a bit confusing. It means equal weighing more often than not. Then equal weight portfolio for you. For example, in Nifty 50, you believe that okay, you want to invest in Nifty 50, but you don't want to invest so much in HDFCs and Reliance, and you will rather have a equal weight approach to all the 50 stocks, and hence you give higher preference to smaller stocks and lower preference to larger stocks, or rather, in a better way to say it, equal preference to all these stocks, then low size is for you. And final is quality, that you are picking stocks which have better balance sheet, better fundamentals, etc. And all of these smart beta products behave differently in different market cycle, right? And that should not come as a surprise. And I think that is where a lot of misunderstanding has also arisen because of the recent performance. Momentum and alpha will do well in bull market more often than not, but they will have underperformance in bear market, because typically stocks which have seen rally more often than not, they fall the steepest when there is market correction, right? Low volatility and quality are expected to be more steady, lower risk, value and low size typically performs when there is a market recovery or a market rally, right? Uh, if you are picking a factor, always look at its behavior in different market cycles, and and then you can decide to invest in two ways. One, you invest for at least 5 to 7 years so that you see at least one cycle which is pro particular factor. If you are investing in momentum and alpha, then you should invest for 5 to 7 years at least, so that at least you see 1 or 2 or 3 good years. Then, when your product will outperform, hopefully, you will get a good return for your entire investment period. The second way to invest is obviously that you time it really well. But then again, you run into the risk of bad timing, which can result in underperformance. For example, if you would have timed momentum and alpha in 2023, 2022, 2021, your returns would have been phenomenal. But if you had timed momentum just for 6 month or 1 year investment horizon in 2024, let's say, your investment experience might not be obviously good. So look at long-term investment horizon. If you are doing it from a timing point of view, then you have to obviously accept the risk which is associated with smart beta. You have to then time it properly, or obviously be ready with the volatility or risk which is associated with smart beta. Now, this particular graph talks about cyclicality, which just shows that in different periods smart beta perform, right? And typically एक product में क्या होता है, right? There are value based fund, for example. If you have two, three, let's say you have invested for 7 years, okay, and if you have 3, 4 good years, your entire investment for 7 years look good, right? So that is what I meant, that if you invest in smart beta, you should stay invested till you see 1 or 2 favorable cycles for that particular factor, or you time it if you want to do that, right? So like you see that in when market was in stress, there was quality and low vol which was doing well. When there was a bull run, you will see that equal weight alpha did well, and even value did well when there was a broad market recovery, especially after a global financial crisis and post COVID. Now, this table again illustrates the cyclicality which is associated. For example, 2020 last 6 months has seen sorts of negative returns, right? Now Nifty looks flattish, but is it surprising to see alpha or momentum underperform? The answer is no. That was always bound to happen. In fact, if you ask yourself when momentum and alpha typically will not work in which shorter period, that is typically in the bear market. So look at 2022 when markets were sorts of flattish, gave only 5% return. Alpha was down by, or momentum was down by 9%. In 2018 when markets were very flattish, 3.3%, then alpha was down by 7.5%. And if you look in 2008, when market was down by 56%, alpha is down by almost 68%. So 13% and relatively underperformance. If you look at 2018, almost 8% underperformance. If you look at 2022, almost 13-14% underperformance. So this behavior we have seen earlier also, and that is what is happening right now. But then also look how well alpha does when market recovers, and that is the idea, right? That you stay invested for the period which is in favor of the concerned factor. Opposite thing you will see in low volatility and quality. Equal weighing also typically works when there's a broad market recovery, right? Because typically in a broad market recovery, you see tail stocks also doing really well, and that typically push equal weight indices also to do well. Now, again, this is March ending data, right? So the data which I'm presenting in this particular slide does not include the sorts of recovery which has happened a month till date, which we were talking about in the first slide. So even then, when you are looking, just look at, for example, again we'll talk about Alpha 30 because that is the pain point for most of the investors. Now, in last 6 months, Nifty is down by 11%. Alpha is down by 22%. So it's 11% underperformance, right? Relative underperformance. And I just showed you in the earlier slide that that has happened multiple times in the history. So again, this was not something surprising. It is how this factor behaves. But then again, look at 5-year performance. Even after this fall, it is 5.5% CAGR outperformance over Nifty 200. If you look at 7-year, again almost 5.7% CAGR outperformance over Nifty 200. If you look at again 10-year, you'll again see almost 6.3% CAGR outperformance over Nifty 200, right? And this 10-year, this index has been live since almost 2016. So most of this is the actual live data. Similar sorts of trend you can look at Nifty 100 low wall 30, Nifty 200 quality 30, value, equal weighing, etc. Equal weight is only down by 10.8% as Nifty 200 has, right? But if you look at again 7-year, 10-year performance, it has marginally done better than Nifty 200. Now, if we before I move towards smart beta and talk about individual product, globally, obviously, smart beta is doing really well. There's more than $1 trillion based on smart beta, but in India, now we are also seeing significant momentum. For example, AUM on smart beta now funds is almost 39,000 crores. So if you're looking at March 2025, the data says that the AUM which is based on smart beta funds is 39,000 crore, which is significantly higher. Just look at 3 years back, which was only 4,200 crores. So you are seeing almost, let's say, 9x jump in the AUM, right? And most popular factors are momentum, equal weight, low volatility, multi-factors, etc. So it has been quite popular, and I think that is why it was necessary to have this session when we talk about how these factors have performed. Now, this is also very important, right? To understand. To understand the behavior of these smart beta indices, right? Because see, simple passive is investing in Nifty 50, Nifty Midcap 150, even multi-cap, etc., where you simply track the market behavior. As soon as you invest in smart beta, you are exposing yourself to a factor. You're exposing yourself to a characteristics, right? That characteristic can be lesser risk or higher risk, high reward, quality, value, etc. And that is why if you look, this is the Nifty 50 based on return to risk profile, right? Risk is somewhat here and return is also somewhat here around, and this is 10-year data. So around 12% return, and we are seeing it here somewhere around the risk. Now just look at how smart betas are stacked in this particular quadrant. We are looking at alpha, right? Much higher risk than Nifty 50, right? Alpha and value are the two most highest risk product, more than mid cap, even more than small cap on a standalone basis. So dono zyada hai, right? Both are on the higher side, but then again opportunity side, which is a CAGR, is also higher, right? Similarly, we have quality and low vol, which is a bit less on the risky side, but their returns are also higher than Nifty 50 in the long run, but not substantially higher, right? So that is also important. So apart from cyclicality, it's also important to understand where these factors lie on a return to risk metrics also. And last point, which is very important to understand, and I think that will sort of explain why low vol didn't do as well as it was expected, is that there is the a portfolio composition, right? So I'll tell you what happens now, and this is very intuitive. When a portfolio is created based on alpha or momentum, it will always consist of stocks from sectors which are doing well, right? For example, right now, as expected, it consists of stocks from financial services, healthcare, right? Relatively segments which were doing well before March end or so, right? Even now, financial services are doing well. So tomorrow, if 6 months down the line, if let's say IT starts doing well, or manufacturing starts doing well, the portfolio will shift towards manufacturing and IT, and your sectoral composition and portfolio composition will change. So alpha and momentum purely tracks segments which are performing better. So it is not biased for a particular sector, but at a given time they can be sorts of skewed too much in favor of a particular sector, right? If let's say financial services and capital goods are only doing well, most of the weightage will be there in financial services and capital goods. So while they are sector agnostic in terms of when stock selection is made, it may happen that at a given point in time इनका एक particular sector पे focus ज़्यादा हो, right? So they are not biased, but कभी कभी they can go overboard, which can happen with alpha and momentum. Now, a different thing happens in case of volatility and quality. Now, if you look at volatility, so what is low volatility? Typically, it means that you are capturing stocks which are more stable, जिनका price fluctuation is not higher, right? You're looking for stable investments. If I say that, which are the first stocks which come to your mind, right? It will be uh, larger private banks. It can be Reliance. It will definitely be FMCG stocks. It will be healthcare segment as well, right? Because these are the sorts of larger blue chip stocks as well as FMCGs and healthcare, which exhibits the characteristics of being sturdy, and that is why अनलाइक अल्फा एंड मोमेंटम जहां पे पोर्टफोलियो बहुत क्विकली चेंज होता है एंड सेक्टोरल मेकअप कैन चेंज क्विकली इन केस ऑफ लो वॉलिटिलिटी इट ऑलवेज रिमेन बायस टुवर्ड्स डिफेंसिव stocks and segments which are more sturdy. Similarly, in case of quality, it will always be biased towards segments which exhibit high return on equity like IT, FMCG, etc., lower debt. Again, IT, right? IT has a DE of almost zero in most of the cases, right? And low profit variability, which typically happen in case of which typically happen again in case of कहाँ पे प्रॉफिट कम वेरी करता है typically in case of FMCGs, even in case of IT where profit is more steady, whereas if you imagine, think of capital goods, think of energy, etc., profit can vary significantly based on the market cycles. So again, here in quality also you'll see segments which are permanently present in the sorts of portfolio. So you'll see low vol bias towards FMCG, healthcare, larger blue chips, which typically show stable behavior. Quality will always be biased towards IT, FMCG, etc. The point which I'm trying to make is now if you have looked at how the stock selection is done, you have looked at calendar year returns, you looked at risk return profile, you have looked at now at sectoral composition. So performance of any smart beta will depend on first whether the cycle is in favor of a particular smart beta factor, right? And whether in the long run you want to be associated with that particular factor. If you believe that India will do well in next 3 out of 5 calendar years, alpha is a perfect product, right? But if you believe that no, you want to have a sturdy portfolio, there will be volatility. You want lesser volatility, right? Then low vol is right portfolio. But the one more question is that can there be a scenario where there's a very negative backlash against a particular sector? For example, let's say you want to invest in a quality portfolio, right? And this scenario looks okay to invest in a quality portfolio, right? That the markets are choppy. It's better to invest in companies which have better balance sheet, better cash flows, etc. But can there be a scenario जहाँ पे because of Trump policies, IT services are impacted very negatively, right? We discussed a couple of slides back that IT is the only segment apart from metals which have fallen in this month till date, right? I think IT has fallen almost more than 7%. Can if this continues, if Trump is if IT services gets impacted by Trump policies, by possible US recession, by cancellation of orders from offshore entities from US, from Europe, etc., and IT is negatively impacted, even though this scenario seems okay to invest in quality, this particular portfolio will not perform because it is too much focused on IT. So that is something which you should additionally sorts of focus on. That okay, I want to invest in quality index, quality smart beta, but am I okay with the sectoral biasness of IT in this particular portfolio? For example, right now I will not invest in Nifty 200 Quality 30 Index because I am sorts of not very comfortable with what is happening on the IT. Plus, it has very lower weightage on financial services, where personally I am sorts of keen on. So that is something where I will not pick Nifty 200 Quality, right? So that is how obviously you should also look at the portfolio, that whether you want to take exposure to a certain factor, whether you are okay to invest for a longer horizon where at least one or two periods are in favor of your concerned factor, and third, are you okay with cyclicality? Fourth, have you understood the sectoral biasness or any biasness of a particular factor? Now, very quickly, what happened in low vol? I think if you look from a performance point of view, in last 6 months, low vol fell by almost 12% and Nifty 100 fell by 10%. I think that this question was more, and why we are talking about low vol, because if I remember correctly, by Jan end, low vol was underperforming Nifty 100 by more margin. I think by almost 5-6%. So low vol शायद, if I remember correctly, 16-17% गिरा था and Nifty 100 was down by I think around 11-12%. So उस टाइम पे ऐसा क्यों हुआ था? Because if everyone remembers, the second quarter earnings came out really bad for FMCG companies, for consumer companies, and consumer segment, consumer sector got impacted first, which is unlike what has happened when earlier deep correction started or earlier sorts of market volatility started, right? And this time was probably one of the few times, or probably the first time when FMCG and consumption got impacted the most. And that is why initially low vol underperformed and there was obviously a lot of questions. But now, obviously in last 3 months, we have seen that low vol is performing in a way how it is expected to perform. So for example, in last 3 months, you see it has fallen similar, but with lower risk. So volatility is just 12% compared to Nifty 100 of 13%. 3-month return is minus 1.8% compared to 1.6% of Nifty 100. Even if when we look at 7 and 10-year data, it is still outperforming Nifty 100 by almost 1.5%. And this product will remain sorts of skewed towards FMCGs and healthcare. I think if you ask me right now, you can take exposure in in low volatility 30. Obviously, look at the numbers which are coming from consumption companies. If you are seeing sorts of rural and urban consumption sorts of stabilizing, positive news on that front, I think you can look towards having exposure in Nifty 100 low vol 30, depending on, obviously, as I said, market commentaries around the consumption segment and the healthcare segment as well. So that is how sorts of look at low vol, not only consider the fact that these consist of stable companies, which have lower price fluctuation, but also sorts of whether from a sector exposure point of view, things are looking good for consumption as well as healthcare. And if you look at the constituent, ITC, Nestle, Sun Pharma, ICICI, HDFC Bank, Hindustan Unilever, Britannia Industries, etc. Again, a very sturdy portfolio also. This is the how Nifty 100 low volatility has performed as of yesterday, and this is the entire data set, right? Like I was mentioning, you see sorts of coming back of Nestle, ITC, Britannia in terms of return in last 1 month. You see Titan also giving almost 9.2% return, Britannia up by 10.7%, Nestle up by 7.2%. Just look how sorts of poorly they were performing earlier. Now, in terms of negative impact, like we discussed, Wipro had a negative impact, down by almost 10.1%. It has the stock with sorts of lowest weightage in the index, 2.3. So this is the weightage, 2.3. Yeah. So Nestle at 4.1%. Gave a return of 7.2%, whereas Wipro has a weightage of just 2.3%. It is negative by 10.1% on a month till date. Larsen negative by 6.3%. Dabur India 4.6%. Infosys and HCL negative by 9.5% and 6.4%. And TCS down by almost 8.1%. TCS having a weightage of almost 3.2%. Sorts of mixed bag. Like I said, that FMCGs and banking has done well. There has been a negative impact from the tech segment. Again, if you are looking at investing in Nifty 100 low vol 30, just look at earnings which are coming out from consumption companies, etc. And if sorts of it looks to be a sorts of stabilizing in terms of rural and urban consumption, you can look towards having exposure in this particular portfolio. I think IT exposure has corrected already significantly, and things could look positive for the low vol portfolio henceforth. This is again which talks about sorts of drawdowns of low vol. As you can see across history, low vol has fallen less than how Nifty 100 has fallen more often than not, right? I'm looking at all the calendar year data. The exception has been 2013. Exception has been obviously the latest year, which is 2024, when Nifty volatility, because of poor consumption data, fell by 13% from a drawdown point of view compared to 11.3% of Nifty 100. Now let's talk about alpha. I think where people are more keen to know about what is happening on alpha. Now, this is March ending data. So by March end, alpha was down by almost from a 6-month performance point of view, 22%, right? Whereas Nifty 200 was down by 10.8%, so almost 12% relative underperformance. But even then, if you look at 3-year data, 17 versus 13.3, 5-year data 30 versus 25, 19-year data 19 versus 14.3. So that hasn't significantly diluted the long-term performance of this particular index, which obviously is a high risk, high reward index. It has higher volatility, it will have higher drawdown, it will have it will have higher churn, etc. Right now, if you look at companies, BSC, One Communication, Method Finance, Divi's Lab, Vedanta, Dixon, Interglobe, Glenmark, Bharti Airtel, Mahindra and Mahindra being the top 10 constituents. And this is how sorts of market cap has changed. Now, in terms of market cap, it's 50% large cap, 50% mid cap, which seems to be a good allocation right now, right? This was very much skewed towards mid cap in 2021. You can look almost 61% towards mid cap. It was very much skewed towards large cap in 2018-19, almost 80% large cap. Right now it is 50-50. From a exposure point of view, looks decent. 27% financial services, 14.7, 14.8% towards consumer services, 10% towards healthcare, 8% towards capital goods, 8% towards consumer durables. And this is obviously sorts of how the markets have behaved, right, in terms of what is doing good and what is not doing good. So again, from a risk reward point of view, it is good fit for someone who is sorts of okay with higher risk, right? And we talked about that how it has underperformed in 2022, 2018, 2008. So this underperformance, relatively correcting more, is something which is associated with alpha and momentum. So no need to be obviously very concerned. Though obviously, having said that, you should be aware of how much risk and drawdowns you can take. If you cannot take drawdowns and risk, alpha is not the right product for you. In terms of performance, again, this is the weightage on the rightmost side. BSC, this is yesterday's ending data. The BSC weight has increased from 5.9, which was March, into 6.4. Then the second top is Dixon, 197, Divi's Lab, Muthoot Finance, Interglobe, Vedanta, Bharti Airtel, Indus Tower, etc. And you can see the best performance on a monthly date is coming from BSC, Dixon, 197, Indus Tower, Solar Industries, etc. Kalyan Jewelers also sorts of reviving after a significant fall before that. So I think best way to invest right now in alpha is to obviously invest in a staggered manner, and we have been talking about that. Typically, it is good to invest in products like alpha when there is correction, deep corrections, right? Because that provides you a good entry point. So alpha from a portfolio point of view looks okay to me, and you can do staggered investing in alpha. The two products which are very similar in nature is small cap momentum quality ETF and mid and small cap momentum quality ETF. Here the stock selection is on the basis of, first, we exclude illiquid stocks. We exclude stocks which have hitting too many price circuits. We exclude stocks which have promoter pledging बहुत ज़्यादा है, right? Then we assess all stocks based on quality metrics, which is highlighted here: ROE, EPS variability, डेट इक्विटी रेशियो. जिसका लो डेट इक्विटी रेशियो होता है, जिसको लो EPS वेरिएबिलिटी होता है, जिसका हायर रिटर्न ऑन इक्विटी होता है, we give it a particular score which is called quality score. And then we also look at 6-month and 12-month risk adjusted stock performance. Stocks which are doing well on quality and momentum both are selected to form part of the portfolio, and this is sorts of what you can look from a performance point of view. In last 10 year, it has given 17.6% return versus 14.4% of small cap 250 index. So this is something which sorts of will give you a multi-factor view, sorts of जहाँ पे stocks are selected based on momentum, so which are doing well as उनकी balance sheet थोड़ी stable होनी चाहिए. So it will not consist of stocks जिनका performance तो अच्छा है लेकिन उनकी balance sheet खराब है, या फिर balance sheet तो अच्छी है लेकिन performance खराब है. And this is basically picking stocks based on both, I think, which are doing well on both. And the top stocks, obviously, you can see is CDSL, Radico Khaitan, MCX, 361, Suven Pharma, Blue Star, CAMS, etc. And again, from a weightage point of view, the top stock will only have a 3% weight. It just helps us with liquidity that किसी भी stock का बहुत ज़्यादा exposure नहीं होगा. So top stock will only have 3% weight, so that we are able to manage liquidity also in case of both deployment as well as redemption. So this is Nifty 200. Similar track, there is mid and small cap momentum quality, which works on similar method, but here we are picking out 50 mid cap stocks and 50 small cap stocks on the same method. So there's no other product. Now others have launched index funds on similar index which we sorts of conceptualized, but apart from this index there's no other product where you are able to take exposure in mid and small cap in a focused manner, right? So this particular index will have 50 momentums or 50 mid cap stocks and 50 small cap stocks selected based on same methodology which I described earlier. And again, a very easy way sorts of to take exposure in in a single product in mid and small cap both. So that is something which no other product provides. Typically, from a weightage point of view, around 75% is towards mid cap and 25% is towards small cap segment. So again, this is a particular portfolio. You see BSC at 6.3, Dixon 4.7, Persistent, Coforge, CG Power, Lupin, Blue Star, Marico, Colgate, HDFC, MC, etc. A very good portfolio of 50 small cap stocks and 50 mid cap stocks in the portfolio. Now, last two are what we have recently launched is BSC 200 equal weight, where all 200 stocks have equal weight, right? So each stock has 0.5% weight. So it's a proper equal weight strategy, does well when there is a broad market rally, right? And because it is giving equal weight to all 200 stocks, your top 100 stocks, which is large cap, will have 50% weight. The bottom 100 stocks, which is mid cap, will also have 50% weight. Even within top 100 stocks, जिसमें से top 50 is Nifty 50 and top bottom 50 is Nifty Next 50, will have 25% weight. So it is equal weight in two sense, where not only all stocks are equally weighted, large and mid cap is 50-50 each, and Nifty 50 and Next 50 is 25% each. So a very interesting way to approach the equal weight strategy. And then again, this is a broader strategy which sorts of does well if there's a broad market rally. If you believe that in the longish run, markets will be driven more by smaller companies, relatively smaller mid caps, relatively smaller large caps, etc., then this is the right product for you from an investment point of view. And also it addresses the entire concerns of concentration in particular segment. Now, if you do not want to have an equal exposure in 200 companies, there's one more product which is Nifty 50 equal weight, which invests equally in top 50 companies only. This is an ETF which we are going to launch pretty soon, and this will invest 2% each in top 50 companies and hence sorts of provide equal exposure to top 50 blue chip companies which are listed in India. And in like I mentioned, that similarly how equal weight strategy typically does, if there's a broad market rally and if in the longest run you expect market to be driven by more wider set of companies instead of top 10 or top 5 companies, this is sorts of a perfect product for you. This is more so for exposure equally in only large cap companies. If you want to have exposure in both large and mid cap companies, BSE 200 equal weight is the product for you. Now this is the rolling returns which tells you that what sort of returns you can typically look at if you are investing in Nifty 50, mid cap, small cap, etc. This is very important because I think last two slides will talk about the combination, right? Because when you are looking at smart beta, so one way to avoid cyclicality is obviously to merge sorts of both these smart beta. So one thing which is very popular is to invest in both low volatility and alpha uh, प्रोडक्ट बोथ सो दैट अल्फा का जो हायर रिस्क है वो आपका लो वॉल निगेट कर दे राइट सो you are taking higher risk by investing in low alpha 30 you're sorts of negated by investing in low wall index. For example, in last 3 months you see that alpha 30, and this is again March ending data, alpha 30 was down by 15%, low wall was only down by 1.8%. 6 month में alpha is down by 22, low wall is only down by 12% or so. So if you merge both, typically you are able to sorts of reduce the cyclicality which is associated with momentum or alpha investing. And on the rightmost side you can see that what you typically get if you do that 50-50 ka sorts of allocation. For example, in last 10 years, if you do that, alpha plus low wall has given you 16.4% return. A simple 50-50 investment has given you 16.4% return, which is higher than Nifty 50, higher than obviously low wall, higher than what actively managed large cap and large and mid cap funds have given, and less than alpha 30, but you are sorts of doing that because you are substituting higher risk with relatively lesser risk of a momentum fund. Now, this thing can also be done not just by low vol plus alpha, जहाँ पे your portfolio will be large cap centric. If you want to, let's say, create a multi cap portfolio, you can use our low vol plus alpha plus mid and small cap products to create a multi cap portfolio. Here, what we have done is simply we have given 40% allocation to low vol, 30 to alpha, 20 to mid small, and 10 to small. And based on that, you can look at the performance. If you look at 10 years, 16.4% returns by this allocation versus 13.9% of flexi cap and 15.2% of multi cap funds. And you can look at performance for 7 year also, 5 year also, so on and so forth. So one way to obviously address the cyclicality of smart beta can be combination. Now obviously I've addressed the issue also that in combination also low wall did sorts of poorly in last 3 months of 2024 and first 2 months of 2025, but that was obviously, like I mentioned, of very unique scenario when sort of FMCG segment fell more than the other segments first, and that is where we saw sorts of low wall underperformance, which was sort of unique in obviously last 20-25 years. So if you're risk averse, look at low wall. Risk seeker, look at alpha. If you're looking at an all-weather mid and small cap or small cap, look at our multi-factor product on small cap and mid and small cap segment. Look at alpha plus low wall if you're looking to reduce the cyclicality, reduce the sectoral biasness, and manage portfolio in a much more prudent manner. The most important thing is obviously when you're investing in any smart beta, first understand the risk and cyclicality of a particular smart beta, whether not only from returns and performance point of view, whether from a risk point of view also, you are attuned to how things will happen and may happen. And obviously, like I mentioned earlier, look at certain ones like whether a particular smart beta is overexposed to a certain sector and whether that can affect the fund's performance if you're investing from a short-term point of view, right? If you're investing in a long term, typically things will happen and driven more by the factor performance. If you're looking only for a short term, you also need to look at sectoral exposures also. So that's it from me. I'll just, if you have any questions, please post them on the comment box, and I'll be taking them one by one. So I can see there are 5 questions for me right now. So if you have any questions, please pose them. So first question from Soumya Badar: Are SIPs preferable in smart beta funds? I think in current market conditions, do SIP in case you see more correction happening. Let's say market fell again by 5-10%, then look at buying at dips, especially in case of alpha. Is there any way you can share the slide? So yes, Harsh, we will upload the smart beta presentation on our website. So maybe you can check our website after 1 or 2 days. Let me get that uploaded on our website. So yeah, I think there were a lot of questions on sharing this presentation. I'll just check internally and I'll try to obviously get this presentation uploaded on our website. Possibly you can download it from here. Maybe try after 1-2 days. Otherwise, you can get in touch with your concerned RM, and he will share the presentation. There's one question: any plans to introduce Nifty 500 low vol 50? The answer is no, because I personally believe that if you are investing in low vol, you need to stay in large cap segment, right? आप फिर मिड एंड स्मॉल कैप में जा करके फिर लो वॉल भी एक्सपेक्ट करें, probably it defeats the purpose of the product. So as of now, will not be doing any Nifty 500 low vol 50 product. We'll possibly stay with Nifty 100 low vol 30, where we believe that from a risk point of view, it's a better placed product, because the intention here is not only to target returns, but more importantly, to target return to risk ratio. What is your view on momentum 500? Is this the right time to lump sum in? I think, again, question is anonymous. I think right time to lump sum, to be honest, was 1 or 2 months back when we did similar meeting. We talked about that. Do lump sum in alpha, do lump sum in multi cap, do lump sum in next 50. I think next 50 has recovered really well. Currently, I'll probably, because markets have recovered by 12% or so, and that is what we are looking at alpha. I'll probably do a staggered investment as of now. And if there are dips, I'll top up the investment and invest more at dips. What do you think ongoing tariff war will? I think nobody can talk about impact of sorts of talk about tariff war which very confident, because we don't know how the negotiations are going to pan out, or what Trump is going to do after this. Sorts of moratorium is over, 90 days moratorium is over, etc., right? And global economy is right now too much dependent on what Trump administration says and does. But having said that, what I'll say is that even if we look at the initial measures which were taken by the Trump administration, while there was tariff on India, we were relatively better placed than other Asian economies like Vietnam, China, etc. So relatively, we will be better than other competing economies, and I think that is a slight plus, if you can say. So if negotiation happens, things turn out to be okay, and there's and then well and good. If doesn't happen, then it looks like relatively we are better placed compared to other, especially Asian economies. Can you explain about tracking error, especially in alpha since the fund launch and future expectations? Yeah, I think that's a very good question. So what I'll do now, I'll not talk about tracking difference, Rajendra. I'll talk about tracking difference, right? Because tracking है थोड़ा confusing हो जाएगा. So what is tracking difference? Tracking difference is difference in the return of index versus the return of the fund, right? So in case of alpha, two things are very significant. One is आपका TER. Typically alpha fund जितने भी market में available है उनका TER around is 40-50 basis point, which is okay, right? Which is not very high, to be honest, when you compare it to global markets or smart betas in general in India. So let's say for sake of simplicity it is 40 basis points. So first is for 40 basis point, but second more important is कि alpha में churn कितना होता है. Now let's say what do I mean by churn? कि कितना portfolio on a every rebalancing moves in and moves out. Let's say typically on an average, every rebalancing 50% of portfolio is moving in and moving out, right? So or rather let me take a 50% of portfolio is moving in and so I'm अगर मेरे पास 100 करोड़ का फंड है तो 50 करोड़ का I'm selling and 50 करोड़ का I am buying, right? Now on that 50 crores I pay STT, I pay brokerage, I pay other turnover charges, etc. So typically your impact will be around and again I'm just taking a ballpark figure, let's say 10 to 15 basis point. Again take 12.5 basis point as an average. Again I cannot give exact figure, but let's say 10 to 15 basis point, 12.5 basis point on an average. Now that will be impact on your 50. आप जितनी बार churn होगा, that cost of buying and selling the underlying stocks will also eat into your returns. Let's say if I am buying 50% selling, right, जो मैं खरीद और बेचूंगा ही, so your two-way churn is 100%. एंड साल में अगर मेरा 4 बार ऐसा रीबैल होता है तो मेरा टू-वे चर्न कितना हो जाता है? 400% हो जाता है, विच इज क्वाइट हाई. मैं ज़्यादा करके बोल रहा हूँ कैलकुलेशन सिंप्लिसिटी के लिए, बट आप ये 400% को आप मल्टीप्लाई करिए जो जो मैंने कॉस्ट की बात की है, तो विल सी एन इम्पैक्ट ऑफ लेट्स से 12 basis point around 40 basis point, and I'll just say a range, maybe a range of 30 basis point, 30 to 50 basis point, depending on churn क्या हो रहा है. इस एग्जाम्पल में 50 basis point के आसपास का impact आएगा, but you'll see an impact of almost let's say 30 to 50 basis point because of the churn which is happening. So one is impact of TR, another is impact of churn, and that is the difference which will be there between the fund performance and the index performance. Having said that, see, if your index in the long term is giving 20% return, you will ideally be okay by getting a 19.4 or 19.5% return in case of alpha, right? Because अगर कोई इंडेक्स लॉन्ग टर्म में आपको ज़्यादा रिटर्न दे रहा है तो यू आर ओके विद चर्न, यू आर ओके विद ट्रैकिंग डिफरेंस, यू आर ओके विद इम्पैक्ट ऑफ चर्न एक्सेट्रा. हाँ, अगर अंडर परफॉर्म कर रहा है, then the question will arise. So let's hope that alpha keeps on performing like it has performed from a long-term point of view, and the churn obviously works in favor of the fund, works in favor of the portfolio. The cost associated with churn is much lower than what outperformance this portfolio and this strategy generates. Same sort of issue does not happen in case of low vol, where there is very low churn. Low vol में काफी कम churn होता है. In fact, in March rebalancing, there was I don't think any even stock change in low vol 30 index, if I'm maybe there was no change, if I remember correctly. So yeah, there's one question: what is the rebalancing period of smart beta fund? So volatility and alpha. So low vol based products and alpha based products are rebalanced quarterly, whereas all the other momentum, who are quality, who are uh, value, who are they are momentum quality, they are rebalanced on a semi-annual basis. Yeah. So only low vol and alpha are rebalanced on a quarterly basis. So I think I've answered all the questions. So yeah, guys, thank you for attending this webinar. I hope I was able to clarify doubts around smart beta products. I hopefully I was able to educate about smart beta investing. So please, obviously explore these products, but understand the risk, reward, cyclicality, and sectoral biasness of these products. If after understanding these smart beta nuances, if you feel that particular product is aligned with your investment objective, you can choose to invest in these particular products. So thank you for attending this webinar. Have a great week ahead.